Okay, so let's finish up Chapter 3. This is the last mini lecture for Chapter 3, and we're also going to finish up a problem that we began in the last problem demonstration. What we'll do is we'll take a look at how to balance out accounts and produce one of these unadjusted trial balances for the problem that we were working on. Now, the unadjusted trial balance in this chapter is exactly the same as the one you prepared in the last chapter, except in the last chapter, we had no revenue and expense accounts on it because we had not yet learned how to journalize those transactions. An unadjusted trial balance is simply a listing of the T account names and the balances of those accounts. And then we add down to make sure that the total debits equal the total credits. If those don't equal, refer to the notes that you have from Chapter 2. As to how to find out why. Remember, first we just add down again to make sure that we recorded the amounts correctly in our calculator, and then we double check our account balances as to what accounts they should be in. Assets get increased on the debit side, so we should have normal debit balances. The same thing with expenses. Liabilities, equity, and revenue accounts should have normal credit balances. Now, why do we call this an unadjusted trial balance? Well, in the next chapter, in Chapter 4, we're going to be learning how to do adjustments or adjusting entries. And so this trial balance comes before that, and consequently we call it an unadjusted trial balance. So let's go to the problem that we were working on previously. And the last thing I asked you to do was to continue posting transactions so that we would be able to now calculate the balances of all of these accounts. So just as a reminder on how to calculate balances, we add up all the debits, including the beginning balance, and then we add up all the credits and subtract. So let's add up all of these debits. 10,000 plus 9,500 plus 10,000 plus 7,500 plus 12,000 equals 49,000. So the debit side is 49,000. The credit side is 3,500. Subtract the credits from the debits, 49,000 minus 3,500, and that gives us a balance or a difference of 45,500. That balance goes on the larger side. So we have a debit balance to the cash account of 45,500. For accounts receivable, we're going to add up our debits, 12,500 plus 15,900. That equals 28,400. Subtract the credits, 12,000, and that gives us a balance of 16,400. It goes on the debit side because there are more debits than credits. Let's continue on with the rest of the assets. For the supplies account, we're going to add up the debits, and there will be no credits to subtract. So supplies will have a debit balance of 1,800. Equipment will add the two debits, and there are no credits to subtract, so we will have a debit balance of 17,000. Now let's go to our liabilities. Let's add up all of the credits to accounts payable. 5,000 plus 1,000 plus 1,250, and that equals 7,250 in credits. Subtract the debits of 500, and that gives us a balance of 6,750. It goes on the larger side. Since there are more credits than debits, we have a credit balance of 6,750. For the deferred revenue account, we'll simply add the credits. 2,500 plus 7,500 is 10,000. There are no debits to subtract. We have one more liability, and that's notes payable. We only have one entry there, a credit of 9,000, so that becomes our balance. For common stock, We're going to add the two credits. $12,000 plus $10,000 is $22,000. Retained earnings only has one amount, so that becomes our balance, $8,800. Now let's go to service revenues. We will add the two credits. $9,500 plus $15,900 gives us a total amount of credits of $25,400. There are no debits to subtract. And finally, utilities expense. We have one amount there, $1,250 in the debit position, and that becomes our balance. So what we'll do now is our unadjusted trial balance. We're going to copy all of the accounts, their names and their balances, onto our unadjusted trial balance. Let's start with cash. Cash has a debit balance of $45,500. So we put that in the debit column. Accounts receivable has a debit balance of $16,004. Now our supplies account, debit balance of $1,800. Equipment, debit balance of $17,000. And we're done with the assets. For our liabilities, accounts payable, a credit balance of $6,750. Deferred revenue, a credit balance of $10,000. So that goes in the credit column. And then our last liability is notes payable, a credit balance of $9,000. Now to our stockholders' equity. Common stock, a credit balance of $22,000. Goes in the credit column. Retained earnings, a credit balance of $8,800. Service revenue, credit balance of $25,400. And finally, utilities expense debit balance of $1,250. Now our whole purpose in doing this is to make sure the total debits equal the total credits. So we will add down all of our debits and they total $81,950. We add down our total credits and they total also $81,950. Now in the next chapter, this unadjusted trial balance will become the basis for preparing our adjustments or our adjusting entries. Let's take a look at the last topic for the chapter, and that is the net profit margin. It tells us that the income statement provides the main measure of a company's operating performance or success. It's useful to consider whether revenues are growing faster than expenses. So what we can do is calculate what percent of every sales dollar ends up as our net income. We would do that by taking our net income and dividing by our total revenues. That will give you a decimal answer. If you want it in a percent, multiply it by 100, or you can move the decimal place 2 points to the right. So this tells us how much profit you're making from every single dollar of revenue, and a higher ratio means better performance. Now, it's good to use ratios when your dollars change dramatically from period to period. So, for example, if you normally have high sales in the months of October, November, and December, but much lower sales in the summer, you can tell whether you're still earning the same percent of net income out of every sales revenue dollar by calculating this formula. So let's try this for Tango. Let's first find out our net income. We only have one revenue and one expense. So if we just quickly do a calculation, our revenues total $25,400. Our expenses total $1,250. Not very much at all. That gives us net income of $24,150. To calculate that net profit margin, we would take our net income, $24,150, and divide by our total revenues, $25,400. I like to multiply it by 100 to change it into a percent, and 24,150 divided by 25,400 times 100 gives us 95.078%, or rounded to one decimal place, 95.1%. That means 95 cents out of every sales dollar ends up as net income, which is an admirable percent for any business. And we are now done with Chapter 3. So please, if you have not yet begun your homework, please do that, your homework problems, as well as the concept overview videos. And feel free to email me if you have any questions.